How are you, folks? Enzo DiCasanzo, clinical professor, economics and finance at St. Peter's in Jersey City. And today we're going to be talking about three different things. We're going to talk a little bit about the macroeconomy, we're going to talk about tax deductions, and we're going to work on assignment 6. Okay. All right, folks. So we were here last time. Or not last time, but what Elon Musk thinks, what Jamie Dimon thinks about the macroeconomy, and we're not going to go through. There's 12 pages here. I'm not going to go through all 12 pages. We'll just talk about a few things for a few minutes, and then we'll get to the notes that we're talking about. It says 91% of U.S. CEOs anticipate there'll be a recession between now and next Christmas, according to a major accounting firm survey. The economic uncertainty has prompted dozens of major companies to announce layoffs and hiring freezes. And from Tesla to FedEx, there's a couple predictions from CEOs of 10 of the nation's top companies. And we have some of those predictions here. Ken Griffin, there's some news about Ken Griffin, and we'll talk about that. But it says 1/3 only believe that it'll be mild and short. Okay, so it's not going to be like almost, I hate to say it, like the pandemic. Even obviously the pandemic was very stressful, but it's not going to be like the pandemic recession where we just sort of bounce back right away. It's not going to be that way. The central bank has been hiking interest rates for quite a while. And again, I mean, look, a federal agency, Jay Powell saying, "Oh yeah, well, these interest rate hikes, it's not going to trigger a recession." But unfortunately, the quantitative measure of having these interest rates is you do have a drop off in employment or a rise in unemployment. So those are sort of natural impacts of increasing interest rates, and especially when you increase interest rates quickly. Okay, and again, I think in previous videos we talked a little bit about recessions, a little bit about stagflation. I think I have some stagflation notes here somewhere. Yeah, we had just very quickly what stagflation is. It's an economic cycle that's characterized by slow economic growth, high unemployment rates, and accompanied by inflation. Economic policymakers find this combination particularly difficult to handle, as attempting to correct one of the factors that can exacerbate another. So trying to reduce inflation, you might cause higher unemployment or slower growth. So that's the fussiness of dealing with stagflation. Once thought by economists to be impossible, stagflation has occurred repeatedly in the developed world since the 1970s oil crisis. In mid-2020, many were saying the United States has not entered a period of stagflation, but soon might experience one for at least a short period. Forbes magazine argued that a period of stagflation was likely because economic policymakers would tackle unemployment first, leaving inflation to be dealt with later. So certainly having people working is important. Okay, that's certainly an important piece of the puzzle. But again, it's simultaneous sort of unappealing characteristics of employment, prices, and economic activity. So slowing growth, more people unemployed, increasing prices. And again, people said, hey, economists and whatever it might be says, that this might not be might not be such a realistic set of circumstances to happen, but certainly it has been happening. It was first defined, I guess, in the 1960s by a British. I didn't know that. He called the combined effects of inflation and stagflation a stagflation situation. Again, the 70s situation, which caused a recession, included 5 consecutive quarters of negative GDP growth. Inflation doubled in 73, hit double digits in 74. Unemployment was 9% in 75. So this is the sort of the textbook example of this. The effects of stagflation were illustrated by means of a misery index. This index is a simple sum of inflation rates and unemployment rates, track the real world effects of stagflation on a nation's people. There's this Phillips curve situation, which is based on the Keynesian idea of income and consumption. As portrayed macroeconomic policy as a trade-off between unemployment and inflation. As a result of the Great Depression, the ascendance of Keynesian economics, economists believe became preoccupied with the dangers of deflation and argued that most policies designed to lower inflation tend to increase unemployment, where policies designed to lower unemployment rates can increase inflation. So, you're trying to correct one and you're hitting something else. That's sort of the problem with this. So the advent of stagflation across the developed world later in the 20th century showed that this was not the case. Stagflation is a great example of how real-world economic experiences can run roughshod over widely accepted economic theories and policy prescriptions. It says in the past 50 years, every declared recession in the U.S. has seen continuous year-over-year rise or increases in consumer price levels. So there you go. So I yelled that out for a reason. There's a sole exception, the 2008 financial crisis, which was a very unique, situation. There's causes of stagflation, oil price shocks, and poor economic policies. The gold's not having the money supply or the value of currency tied to a specific metal standard or things of that nature. But then what's the difference between stagflation and inflation? Okay, there's a couple questions. But like I said, I wasn't going to go over this whole entire thing, but just keep in mind that the general idea, it's a shock effect for inflation, employment, and economic growth, all going in sort of the wrong directions. That's basically what stagflation is. Yeah, certainly credit cards, loan debt, those are all tied to interest rates. So as you're increasing, you may not necessarily feel the effect right away, but certainly down the road, all of these interest rate increases, the longer term effect, may be hitting us down the road. And every time you raise these interest rates, you sort of kick that effect, further down the road as you go along. So this is now what we have here. We have the Tesla guy. I'm not going to read every single one of them. Tesla, FedEx, Hilton. Here, what does the Hilton guy have to say? The hospitality CEO is a little more optimistic. He goes, by mid-October, he believes there's a reasonably good chance the economy will have a soft to bumpy landing. In July, he told investors that while there's a lot of macro uncertainty, he feels good about the hotel giant's future. Bob Nardelli, the former Home Depot and Chrysler CEO, he said the recession is going to hit the U.S. like a rocket ship. Or I'm saying, it's been sounding the alarm of the recession hitting the U.S. like a rocket ship for months now, telling Fox News that the nation is the least prepared to face the recession that he's ever seen. We see what Jamie Dimon thinks, and again, his economic team is coming up with 20 to 30% chance of something worse happening. He predicted that a downturn will be much softer than the economic hurricane he originally forewarned. And his company most recently earnings report that people's savings are up compared to this time last year, and even more than pre-COVID. Credit card borrowing, he said, is also relatively stable. So he's trying to find sort of the golden characteristics to say, hey, things aren't so bad. Which is, somebody like that who's a semi-politician. They're looking for the silver cloud here. But he says the extra money that people have in their checking accounts will probably be depleted by sometime next year. And then you have inflation, higher interest rates, higher mortgage rates, oil volatility, all of those things out there will cause strains. Will cause strains in people's balance sheets and people's economic activity. And, these are all stresses and strains that are, otherwise necessarily wouldn't be there. We generally don't have a state of war. You generally don't have such high oil prices and things of that nature. Okay. The Goldman Sachs guy says there's a global economy continues to face significant headwinds. He mentioned that equity markets being well off recent highs, central banks raising interest rates, and geopolitical instability were all exacerbating factors that impacted the general investment bank's performance in the last couple months. And he says there's a good chance we'll have a recession in the United States. Although, like I said, I didn't work out the numbers just now, but I think we've had a couple quarters of negative economic activity appreciation. So that, to me, that's the definition of a recession. But apparently, people are looking for different. The White House is looking for different definitions. The Citadel guy, he goes, we'll have a hard landing. Absolutely, Ken Griffin thinks that. Okay. The Deutsche Bank guy bracing for a recession. Microsoft, none of us are immune to macroeconomic headwinds. Okay, so those are a couple comments from a number of those people. And then, you have the financial institutions and, Tesla, the Tesla guys out there saying whatever it is that he's saying. But then you have the Walmarts and the Wayfairs and the Googles and the Microsofts. And when they start freezing hiring, that's another concern, for sort of what's going on. Microsoft is letting hundreds of contractors go. Facebook is in a hiring freeze. A wave of layoffs is sweeping through Netflix. Okay. Amazon says it's overstaffed its warehouses. In a rare move, it said it hired too many workers. Okay. So Walmart is overstaffed. Uber announced its hiring slowdown and cutting marketing costs. Okay, so those are sort of the everyday companies saying that. So it's not the sort of the financial companies sort of have some sort of reason for saying what they're saying, and they have sort of I'd say an ulterior motive, but also an ulterior motive in pitching that the economy is going to go one way or another based on their positions, right, and based on the bets that they've made on the movements in the financial markets. Okay, Ken Griffin is here, and he's unhappy about being in Chicago, and I don't know what's. I was looking for their assets under management. It says, oops, hold on. Citadel, it says, since the start of 2019, hedge fund Citadel and market maker Citadel Securities have doubled their combined headcount in the region to roughly about 750. Now in the region, that's the European numbers, and actually Ken Griffin is looking to expand in Europe. They're one of the most significant recruiters in the world of asset management and trading in recent years. He certainly sees a return to volatility across asset classes, and a very sophisticated financial management firm like Citadel. They're going to want to take advantage of that volatility, done everything that they're not, and from in a very quantitative engineering manner. Always keep that in mind. But soaring returns and rising assets are boosting their fees and ability to lure people that need to take advantage of one of the best trading opportunities in a decade as central banks retreat from the quantitative easing. I don't see what they're now. I know Ken Griffin's worth 29 billion. I don't know what his company, what Citadel managed, but it's got to be like 100 billion or something like that. It's got to be in that area. Okay, they employ 4,000 people. Okay, they've done that. And this is some of the property that Ken Griffin bought. I mean, when you're buying property that's 100 million, that's worth, you're spending 100 million on property. That's an acquisition of an asset. And some of the funds, was talking about a colleague, Citadel, the Wellington fund is returned 29% through September. Millennium is another hedge fund, gained about 10%. Blue Crest has seen about 100% return. So these guys, even though the markets are going left, these guys are going going right, or up or down, however you want to look at it. So they're having gains. Well, the markets, just the general buy and hold index fund member, index fund subscriber, they're down like the S&P 500 is down. But these guys have are using derivatives contracts and things of that nature to certainly make bets on the markets. So okay, but like I said, there's a lot more we could talk about here. If I spend a few minutes talking about the economy, we're going to talk about the material for assignment number 6, which this has been posted. Okay, and this is due in about 2 weeks, or maybe a little bit more than 2 weeks. Actually, it's due in about 3 weeks. So yeah, I gave you a lot of time on this. So it's 1, 2, 3. Oh, I gave you about 4 weeks. So there'll be another one. There'll be another assignment. Assignment number 7 will also be due this week. All right, because you have a bunch of weeks to work on this. There's a couple questions here about itemized deductions and instructions from Schedule A. We've had discussions about that over time. The difference between tax deductions and tax credits, and standard deductions and itemized deductions, and things of that nature. So you want to have some good understanding as to what the differences in all this stuff is. You want to look at some of the federal tax brackets, and actually your assignment is for 250,000, but the model that we're going to work on, we're only going to work on an $80,000 model in terms of earnings. So, but you're using a different number, so you might have more brackets to use. Always keep that in mind. Okay, and you're gonna create models for versions of no deductions, standard deductions, and itemized deductions. So you're creating 3 sets of tables, and you're going to use the IRS instruction Schedule A, which is about 18 pages long, to figure out which where some of the deductions are. Okay, and again, I want a cover page, and actually we'll do I'll create a quick version of this as we're sitting here. So I'm saying I'll cover page. We'll sort of get back to all that stuff, and actually while we're sitting here, just to look up where the cover pages were. All right, we have a cover page somewhere here, right? I have some kind of cover page. Uh, yeah, so this is for assignment number 6, right? And we'll get to this. We'll get to this for 6. And again, you want to put the appropriate, if this is economics, put economics. All right, your last name, first name, you got to put all the appropriate information in there. You don't need questions and any of this other stuff. So we'll say file, save as. And this is due November, I think it was due November 14. Okay. And yeah, you put your last name, first name. We'll get to all that stuff. I think it was the 14th. Yeah, this was due on the 14th. And like I said, and we'll get rid of some of these questions. We'll put some of the other questions in there. Actually, we could do that now while we're talking about this. Yeah, here. These are some of your questions. And now the brackets, these 3 models, you're going to have to use something else for that. Okay, I'm saying you're going to have to use the. Okay, and I don't know. We used whatever. This is now the graphics, and actually we like, what do we like? We like New Times Roman is what we like. Okay, and this is some other stuff here. Yeah, we're not doing congressional budget office. That we're not doing. This we don't need. This is graphs. We don't need that. And there's another graph in there. So. And this is number 4, which is the same thing, creating a PDF and all that stuff. But this is just number 4. Okay, and like I said, so this is we put and again, obviously you type all of your answers in here. I just copy and paste it is what I basically did. I just copy and paste it here, and then we're going to get to the tables in a second. But I want to get to the lecture on tax deductions, and we discussed this stuff in class. I could use this one, any of these, whatever. I can use this one. Right, what a tax deduction is. It's an item you can subtract from taxable income to lower the amount of taxes that you owe. You can choose a standard deduction, a single deduction at a fixed amount, or an itemized deduction on Schedule A of your income tax returns. It's the value of your itemized expenses I'm saying if the value of your itemized is greater than the standard deduction, then it makes sense to itemize. And your allowable itemized deductions can include mortgage interest, charitable gifts, unreimbursed medical expenses, state and local taxes. And like I said, we can look at the instructions for Schedule A. And if I can quickly find them, we'll talk about them just very briefly. All right, and it says right here, you can either part of your medical and dental expenses, amount you paid for certain taxes, interest, contributions, other expenses. You can deduct certain casualty and theft losses. And these 18 pages goes through, the details of that. Now, look, we're not. This is not a course in taxes, but that's what. So medical and dental expenses, and then, it goes through the very specific detail of all of this. Taxes you paid, taxes you can't deduct. You can't deduct Social Security, Medicare, federal and state gift taxes, certain state and local tax. So again, there's very specific deductions you can make and deductions you can't make. Property taxes, other taxes, real estate taxes. So, and again, looking at these, which ones you can. And again, there's all sorts of. This is almost like a textbook. There's all sorts of examples in here, which is really good. For you guys to spend some time on this. It says line 5, the deduction for the state and local tax is limited to 10,000, 5,000 if married filing separately. And then again, there's all sorts of details, state and local income tax. If you don't elect it to deduct general sales taxes, including on line 5A, and there's other, I'm saying I think you can sort of pick some of these, which ones you want to deduct. But if it's just a commodity, what you're deducting, what you're not deducting. So if there's a limit and you're banging up against the limit, state and local general sales taxes, actual expenses. Well, like I said, it would be a whole, I'd be doing a tax course, really going through all this. But you can see it's like a worksheet, and it goes through all the details of how to deal with all of home mortgage interest, not the home mortgage payment, but what you pay as interest. So in class, I got those confused myself a little bit. So you got to be very careful with that. Gifts of charity, or what you can deduct, what you can't deduct, gifts by check or cash, and it goes through all the details on and on and on through all of this. Casualty and theft and losses. Okay, so, but like I said, there's some detail that corresponds to this. Tax deductions are subtracted from your taxable income by lowering the amount of tax you owe. You can choose a standard deduction or itemize your deduction Schedule A of Form 1040. The Tax Cuts and Jobs Act nearly doubled the standard deduction, improved several tax deductions. The Tax Cuts and Jobs Act also eliminated or limited many itemized deductions, including the mortgage interest deduction. If you itemize your deductions, be sure to keep receipts to substantiate the expenses. Okay, like I said, I keep mentioning in class about the Tax Cuts and Jobs Act, spending some time on that. But like I said, you start talking about legislation, and it's a big amount of time that's involved in that. So the standard deduction nearly doubled under the change in the tax code in 2017. So there's a rundown of the standard deduction amounts for 2020, 2021. So yes, and we've seen we've seen it. You've seen this a number of times. Yeah, so right, you can either take the standard deduction or itemize your deductions, but this is the standard deduction, which just you're checking a box and that's it. Which for most people, these are some pretty good deductions for most people. You're making 70,000 a year, and you're deducting 1/7 of your earnings. You're taking tax on 6/7 of your earnings is a pretty good number. So taxpayers who are at least 65 years old. So yeah, the whole handicap thing, and there's an impact for that. So here are some of those common tax deductions for federal tax returns: student loan interest up to $2,500, mortgage interest up to $750,000 of a secured home mortgage debt, contributions to a traditional individual retirement account, contributions to a health savings plan, medical and dental expenses that exceed 7.5% of your adjusted gross income, which we discussed in previous classes, how to compute that, charitable contributions, investment losses, gambling losses, self-employment expenses, including home office deduction, health insurance premium deductions. So most of the deductions are on Schedule A, but there's some exceptions. For example, there's other forms to fill out, Schedule D and 8949 and things of that nature. You can only deduct charitable contributions if you itemize, and however, you can deduct up to $300 in donations qualifying for charities for 2021, even if you don't itemize. So again, there's all sorts of, if this happens, if that happens, there's all sorts of logic involved in what the federal tax code is. Some deductions that went away. We had personal exemptions, tax preparation fees, alimony payments, mortgage interest, unreimbursed work expenses, state and local taxes above $5,000. So these were once common deductions, but are at least gone until 2025, when the Tax Cuts and Jobs Act is due to expire. There's tax deductions for the self-employed, and they've retained some of the tax deductions the wage earners have lost in the 2017 tax reform code. Small business and tax deductions is another piece of this. Businesses large and small pay taxes on their profits, which is the total receipts minus the total business costs. That means that we're recording every single expense and reporting to the IRS. Some of the top deductions from business owners include, equipment costs, bad debts, books, keeping your books expenses, advertising and promotion. There's a whole listing here if you're a business, kind of a thing. Now, so and the rules of these deductions are complicated, particularly for shoestring operations. And again, having the infrastructure around to sort of advise you on this is certainly a big piece of this. Deductions and tax credits. Deductions reduce your total taxable income. The amount you use to calculate your tax bill. On the other hand, tax credits are subtracted from your directly from your taxes that you owe. So sometimes some tax credits even are refundable, meaning if the credits reduce the tax bill to below zero, you'll get a refund. Some of them are refundable, some of them aren't. So, again, understand the difference between a tax credit and a tax deduction. Generally, the field says tax credits are more valuable. Deductions may kick your taxable income down a few notches on the tax tables, or tax credit reduces the tax bill that you owe dollar for dollar. Okay. Yeah, some of these, I looked at these, and where I got these notes, these were wrong, so I just sort of I crossed these out. But like I said, we went over this in the tax model, or in the Excel model. So for a single taxpayer reporting 80,000 a year, yeah, that puts a person. So yeah, I think that's our example, is the 80,000 a year person. Yeah, yeah, we're gonna do it. So, but your version is 250,000, but we're gonna work on the $80,000 version for you guys. Okay, so yeah, it says it right here. So yeah, so we'll do this 3 times: 80,000, 1, 2, 3, right? And what you can do is you can just copy this, and you can just drop it off, just paste, paste. Okay, as you go, and then we're gonna have to find the 2021 tax brackets, which are gonna be the same. Well, we've done that a number of times. You're picking up those brackets. We'll pick those up in a little bit. But it's a $10,000, or actually it's an $80,000 person that's earning. And in terms of the tax bracket, that's to be determined. And also, you can itemize $10,000 in mortgage interest, $6,000 in a contribution to a retirement account. These are deductible expenses. With the total, the 10,000 plus the 16 plus the 6, which gives you 16,000 in deductions to report the taxpayer will owe income taxes on 64,000, not 80,000 if you itemize. After taking the deduction, the person will owe 10,000 for the year instead. So yeah, so these are some of the conclusions, and we'll hold off on these until we actually work out the model. But there's going to be 3 versions: no deductions, standard deductions, and then the itemized deduction. Okay. So it says if the taxpayer takes a standard deduction for the 21 tax year, it's $12,550 for a single filer. It is important to note the taxpayer will get the deduction for the IRA contribution in any case. It's above the line deduction, reducing the taxpayer's gross income from 80,000 to 74,000 to about $74,000. So again, we'll work that. I don't want to just start guessing on these numbers. We'll work out these numbers as we go along. And this it says the standard deduction further reduces the taxable income to 61,000. With the standard deduction, the taxpayer will owe. Okay, so it goes through the math here, and we'll get to that. I don't want to start guessing on these numbers. Even with a hefty mortgage write-off, the taxpayer saves a couple, 560 more taking the standard rather than the I. So yeah, there's that conclusion, and we'll work out that conclusion in our model. But is it 561? I don't recall if it was 561 or not. 13.9. Yeah, it looks like it's a lot. Well, 13 is a lot. Yeah, so it's this one minus this one, right? It's this. It's that one. Yeah, there's your 561. It's the difference between 9,800, 9,200. This other one is outrageous. If you don't take any deductions at all, I just go through to show you guys that you have to. It's in your interest to, instead of having an effective tax rate of 16%, you can have it down to at 15%, which is, that's not nothing when you're talking about people making $100,000 a year or thereabouts. So yes, you have the itemized deduction version, you have the standard deduction version, and that's going to impact what taxable income is. Okay, and again, the form you're going to fill out. You have state tax deductions generally follow the same format as the federal forms, as close as they can be. Okay. Some other considerations here. There's limitations on some of the deductions. So for 700, so the house has got to be worth, or the property's got to be worth 750,000 of secured mortgage debt. Okay, you have that. 7.5% of adjusted gross income for the medical or the healthcare costs. You've got to exceed that in expenses, and then the difference between what your expenses are and 7.5% of your adjusted gross income is what you can deduct. There's some carry forwards, which we didn't talk about carry forward yet, but carried forward is some sort of tax benefit that, as it sounds like, you can project into other years. Okay, which I'm not sure how much of this how much we're going to spend on this. We'll see if we have some time for carry forwards. But those, it's a little more of an intricate thought process because you're taking a benefit and then spreading it out over a number of years. There's some questions here. What can I write off on my taxes for 2021? How can I maximize my tax deductions? There's a couple questions there which I didn't ask you guys. What is the maximum tax refund that you can get? Are these 2020 or 2021? So some of the years were a little. So yes, I think the person I got the notes from, interchange the 20 and 2021 tax brackets a little bit. So I just want to be careful quoting numbers from here, but just know that there's a certain for a certain earning, there's a certain deduction, a certain tax credit, a certain amount of tax benefit that you can get just sort of based on the rules. And you always want to figure out what that is. Someone who does this all the time can probably say it off the tips of the fingers, but I have to sit down and figure that out. So anyway, but that's tax deductions. And we talked about a couple of the answers to a few of the questions that are here. Where's the questions? I think it's deductions versus standard versus itemized deductions, tax deductions versus tax credits. Okay, and then some of the deductions listed on Schedule A. Okay, so again, we showed you guys where to find all that, in the video. Okay, yeah. Now your assignment is 250,000, but I'm going to work out 80,000. Okay, so let's slide over to the Excel here. And this we don't need. Okay, so here, there's a couple versions of this. The first version is no deductions. Okay, so the taxable income is just simply this minus nothing, minus 0. It's still 80,000. And again, we've looked these up several times, so I'm not going to keep re-looking those over again. But obviously, those are your tax brackets. Yeah, and you may not. So for this particular one, you're not going to necessarily have a deduction in there. Yeah, these I should have. This is standard deduction, which is here, and I listed it up there. But usually we listed it at the bottom. But I'm saying, but these are the tax brackets for 2021 for a single taxpayer. And again, just very quickly, the instructions for 1040. This is Schedule A 1040. Right, I think these are at the end somewhere. Here we go. Right, these are this is the 1040 instructions. There they are for single 9,950, 523,600. You should have these almost memorized at this point. And the rates, again here, these are just the rates, the same rates that we've had: 10%, 12%, 22%. Right, it's all that stuff: 10%, 12%, 2%, 24%, 32%, 35%, 37%. Those are there. And it's funny. This column is a column that people seem to be having difficulty with. So if you have 80,000 in earnings, you got to take the first, right? The first bracket is about 10,000. The second bracket is about 30,000. So what you should have at the bottom, you should have a summation key here, right? That sums these as you go along. So you're up to 40,000, but you need to cover 80,000. So if this is 46, all you should need is the last one. So your taxable income is 80 minus the 40,000. So yeah, the 39 is less than about 40. So you're not using all that bracket. You're using just a percentage of that bracket, because this whole bracket, this bracket here, this bracket is 45,000. You're only using 39,000. So you're using, whatever, almost about 80% of it or so, or in the area of 80%, right? Because this whole bracket is 40. You're only using 39. So there's your 80,000, right? There's your 80,000. And now the rates are just simply the products. Right? 995. And here, you could even just do this Control D and then get rid of the dollar signs. All right, that's your tax liability for each of the brackets. You owe about 1,000, about 3,500, almost 9,000. So here you just sum these. You just add these up right there. Okay, and then your rate is simply the 13,000 divided by the 80,000. I don't know why that's negative, but typo. Okay. This is the no deduction version, which is you have the highest tax rate So these are the brackets that simply just came from the instruction guide here. It's just from here, and here's your percentages. Okay. Now I'm saying now you're going to be using the same tax brackets, so you could just copy and paste these to all the other pieces here as you go along. And also, your reuse is just this. Right? Your reuse is there. That's just your reuse. So we've and also even just as we're sitting here, you can reuse as formulas. You can reuse your formulas too for the effective tax rate. Okay. Now that the itemized version is next. So we have the no deductions version. So what you're going to do after you've done this, you just want to take this table and say copy, and you want to go to your file here, your sort of answer key, and just drop the table in. That's it. That's all you want to do is just drop that table in. That's just how I just copy and pasted it. That's it. Nothing else. And you could move this around a little bit. You can open these up a little bit to get the rates. Right? You can open up the tables a bit. Okay. And I'm saying I'm not going to do this for every single one of them, but you're going to have 3 of these tables here: no deductions, standard deductions, and itemized deductions. Then you're going to type in your answers. You have your assignment here, and that's it with this. Then from here, you're going to save this, right? And then just say file, save as PDF. You're just going to PDF it, and that's it. There's no other, nothing else to do with this. Okay, so this is just a sample of what your assignment is. Just there you go. And this is ready for emails and to send to people, right? This is all, you're all set with this. All set with that. Okay. So here we don't need the instructions anymore. We don't need this anymore. Okay. Hit escape when you have something highlighted like that. Okay, that was the no deductions version. The deductions version, well, it says your mortgage interest rate was or the what you paid in mortgage interest rate was they gave you that number 10,000. Okay, so so this is minus 10,000, right? And then your IRA contribution is minus 6,000. So now that you've itemized, now you have to have documentation for all this. And then this is just sum of 80,000 and the 16. And again, now you've dropped your taxable income to 64,000 from 80,000, right? You're at 80,000 there, and this is 64,000. You have the same brackets here. And now this math, you could just grab these again, I think, right? Yeah, because 64, you're still in here. You're still 64 is still between 86 and 40. Yeah, so you just take 64 minus the $40,000 bracket. And also what you can do, you could just grab these. It's the same, it's just the products. It's the same products. Okay. And also just while you're at it, you can say copy of these two and just drop these two in. Oops. No. You can do it like that. Copy that. And copy that. Okay, so you went down from tax liability of 13,000 to a tax liability of 9,800. So you went down from a rate effective rate of 16.5% to about 15.5%, right, with the itemized version. And the standard deduction version is the next and the last piece of this. Now again, you still can deduct your IRA, and then you have the minus 12,000. Remember this 550? These were your deductions. Whoops. You're summing these. That's a summation of these two. And the taxable income here is down to, whoops. That's down to 61,450. This is 64,000. That's the lowest taxable income. You had 80,000, 64,000, and now you have 61,450. And again, you can do the same maneuvers Right? You can take all your summation formulas. So you see, I'm reusing, right? That's just a summation of a couple lines. And also the amount subject to tax, you could just copy and paste this. So see, once you figured this out, you're just reusing a lot. Whoops, right there, right? This is just right. Well, here, let's go back. This is 10,000. This is the next bracket, 30,000, and then this one you take 61 minus the 40. That's the other 20. This is 61,450. Those are your tax liabilities, your itemized, and then you add them up to 9,000. So what do you have? You have 9,268, 9,829, and then 13,000. So what you would do is you would maybe make a little table somewhere and say tax liability based on I would say based on deduction decision, right? So what do you have? So this is copy here. This is standard deduction version, which is there. This is the itemized deduction version, which is there. And then you have the no deduction version, which is there. And you copy, paste, escape right there. You can say equal 13 equal 9,829 and equal 9,268. Those are that's your table of choices. I didn't ask you to didn't necessarily do this on the homework, but it may not be a bad idea to do something like that. So then you have so as you're advising people, say, oh, here's as we're choosing our version of deductions, the one that we want to minimize. You want the last one, right? You want that last one. That's the smallest one. And you could even program equals minimum of the whole array, and it'll pick out the minimum number. You could even do something like that. See, equals min parenthesis, right? See, it took the minimum of that. That's using the minimum function. Okay. There you go. Okay, so there's your three. Now we did this for 80,000. You've got to do this for 250,000. Remember that, okay? I mean, people say, "Oh, we did something different in the video." Wow, I mean, that's on purpose, folks. Okay, so yeah, so we worked out the file, and you can answer your question. So you copy and paste the tables, and here, if I want to take this last table, just highlight it and say copy, and go over to your over to this. Again, when these things get all sort of uh, compressed a bit, you can always expand it a bit. Okay, and then you can again once you do something like that, you want to resave it as a PDF or something. Okay, so there you go. Okay, so you have the three different deduction versions. You make your tables. I showed you where to look up the tax rates. This is probably so yeah. Now taking this back to the top of the notes, the standard deduction the taxpayer will owe. Oh, yeah, you got to be careful with these. Here's the no deduction version that says the standard deduction version um, will reduce the taxpayer. Yeah, 61,450. Fine, right, and the taxpayer will owe. Yeah, it's 9268. Yeah, it's not that number. Yeah, so I think there may have been some little mistake somewhere. Yeah, because there's no 9467. Yeah, I don't have it. So this is 9268. Okay, with standard deduction is 61, yeah, 400, 450. Yeah. So you got to be careful. Like I said, so with 16,000 deductions, yeah. So for the itemized one, right, it's 64,000. Good, that's right. And this is 349, 348. Okay. And we'll owe 13,349. No, we'll owe 98.29. Yeah, you have to clean up your um yeah, you got to clean these up a little bit. Yeah, 98. So the itemized, yeah, the itemized is 98.29. The standard deduction is 92.68. You got to be careful with this stuff, to not as you're communicating it. The 561 we made sure of. So obviously this is less. Yeah, the 92.68 is less than 98.29. Um, yeah. Okay. But there you go. Okay. Well, like I said though, so you got to just keep everything straight. The three different tax liabilities, the three different versions of deductions. Okay. All right, folks. Thank you very much, and we'll see you next time.